deep dive. This is actually our 20th one. Hitting 20 kind of feels like reaching a psychological support level, like in a long-term bull run. It's a milestone worth noting. So thanks for sticking with us through all the market ups and downs. Today is Sunday, September 14th, 2025. We're digging into the intelligence brief for yesterday, Saturday the 13th. We're looking at a really mixed global market picture. I mean, you've got geopolitical tensions flaring up, ongoing uncertainty about the macro economy, and then some very specific sector news bubbling away. Key things we'll hit today: that drone attack on Russia's Primorsk oil port, the anticipation building, I'm really building, around the upcoming FOMC meeting, and the crypto market just keeps powering ahead. Those were definitely the big drivers. Before we get into the thick of it, just a quick word about our sponsor. This intelligence update is powered by Nextsight. They're a global intelligence and investigations firm, and they do more than just collect data. They use their open source OSINT platform, Site Connect, to turn raw signals into actual strategy.
Plus, clients can tailor reports exactly how they need them, whether it's for market analytics or complex cross-border investigations. Honestly, their work is on another level. You can find out more at www.next-site.com.
That's absolutely right. And in markets moving this fast, information isn't just about the what, it's digging into the why. It's about seeing how all these different signals, sometimes even contradictory ones, come together to form the complete picture, understanding that interplay, like we said, translating signals into strategy, that's where the real value lies in navigating this kind of complexity.
Okay, let's unpack this then. Looking back at Friday the 13th, the markets were, well, all over the place.
Yeah.
Here in the U.S., the S&P 500, it dipped slightly, down 0.05%. The Dow Jones was down a bit more, 0.59%. Investors were clearly, digesting that inflation data and kind of looking ahead, nervously perhaps, to the FOMC meeting next week.
But the Nasdaq, that's the fascinating part.
Right.
It bucked the trend completely, hit a new record close, 22,141.10.
Yeah.
Really carried higher by those big tech mega caps.
Yeah, it signals a real concentration, doesn't it? Growth focused in just a few areas.
Exactly. That strength, mostly from AI-related stocks and the usual tech giants, it really contrasts with the hesitation you saw elsewhere. It suggests investors are being very, very selective. They're placing bets, but carefully, maybe waiting for clearer signals on the broader economy. And you have to remember, the S&P 500, if you look at the chart since March this year, it's been almost a straight line up to record levels. So Friday's little dip, it's minor in that context. It's not panic, more like cautious optimism, maybe some positioning ahead of the Fed.
Okay, and outside the U.S.,
Yeah.
generally a bit more positive, right?
Yeah, mostly. European and Asian stocks had a pretty good day overall. Resilient economic data helped there.
We saw the Euro Stoxx 50, the FTSE 100 in London, both up around 0.8%.
And Japan's Nikkei surged 1.2%. That's partly the weak yen effect still playing out, because of the Bank of Japan's policy.
While keeping those rates low, China's CSI 300 also did well, up 1.7%. Hong Kong's Hang Seng was the outlier, dipped a bit.
Mm-hmm. Property concerns still weighing there.
Now, commodities.
Yeah.
Definitely saw some action there.
Oh, yeah.
Crude oil jumped. That was pretty much immediately after the news of the drone attack on Russia's Primorsk port hit. Supply disruption fears, obviously.
Yep, classic geopolitical reaction.
And gold, still hovering near record highs around, $3,648 an ounce, still acting as that inflation hedge and safe haven.
Absolutely. Persistent inflation concerns keep supporting it.
Okay, fixed income, U.S. Treasury yields drifted lower.
That's right, across the board, really. The 10-year yield dropped 3 basis points, down to 4.01%. That move is investors positioning for, what they hope might be a more dovish FOMC.
Meaning the Fed might take its foot off the gas with rate hikes, or maybe even hint at cuts.
Potentially. That's the anticipation driving yields down ahead of the meeting.
Got it. And crypto just keeps going.
Relentless, isn't it? Bitcoin holding strong around $116,140, Ether at $4,703, both showing solid gains over the week.
And finally, FX markets, relatively calm.
Stable, yeah, but the U.S. dollar index stayed strong, near multi-week highs, about 120.54. It's still benefiting from higher U.S. interest rates compared to elsewhere, those yield differentials and, its role as a go-to currency when things feel uncertain.
So the euro and pound softened a bit against the dollar.
Mm-hmm. And the yen stayed weak.
Okay, so lots of moving parts. How do these things connect? You mentioned the oil price reacting to the drone strike.
Right, and that's a perfect example. You get the immediate geopolitical shock, the supply risk, pushing prices up, but then almost immediately you get hit with counterbalancing news. The data showing rising U.S. fuel inventories, concerns about slowing demand. So it becomes this tug of war. Supply fears versus demand reality, with geopolitics adding fuel to the fire, so to speak.
Right.
And think about that China chip probe we're about to discuss.
Right.
The implications go way beyond just tech stocks. It's a direct challenge to global trade dynamics, supply chains. It hints at this potential shift, maybe decoupling, in how critical components like semiconductors are made and sourced globally. Every single piece of news is like a thread in this huge, complicated global web.
That's a great way to put it. So let's dive into those specific drivers. This is where it gets really interesting, as you said. First, those geopolitical tensions heating up, China's Ministry of Commerce launching investigations, anti-discrimination, anti-dumping, targeting U.S. semiconductor restrictions and subsidies.
Yeah, the accusation is that the U.S. is distorting the global chip supply chain.
And the timing, right before those minister-level trade talks scheduled for Madrid. Pretty pointed.
Absolutely. And they've threatened retaliation if the talks don't go well.
So the impact. Global tech shares took a hit, right? But Chinese stocks actually got a boost.
Paradoxically, yes. The idea is that this might spur more domestic support and investment within China for its own chip industry.
Okay, driver number 2. Those energy market jitters. The Ukrainian drone attack on Primorsk, damaged fuel tanks, sparked those supply fears.
Brent crude closed up near $67, WTI near $63.
But crucially, as you pointed out, those gains were capped. Concerns about slowing U.S. demand, plus those inventory builds. Crude up 3.9 million barrels, gasoline up 1.5 million barrels. That put a lid on things.
It did. It shows the market is weighing both sides very carefully right now.
And then there was that other layer, former President Trump calling for NATO to halt Russian oil purchases, suggesting sanctions. We have to stress, this is just reporting what the sources said, not our view.
Of course.
But it does add another potential disruption factor. If something like that were to happen, prices could spike significantly.
It definitely raises the stakes and adds another layer of uncertainty for energy traders.
Right. Okay, third driver, corporate and labor stuff. The UAW reaching a tentative deal with GE Aerospace.
Yeah, affects about 600 workers. They vote on the 19th. If it passes, that should ease some worries about aerospace supply chains.
And then, shifting focus but with global reach, China's MIIT setting those huge 2025 vehicle sales targets.
Ambitious is the word. 32.3 million vehicles overall, and 15.5 million of those being new energy vehicles, like EVs.
Plus, conditional approval for Level 3 autonomous driving. That must have helped auto stocks.
It certainly did, boosted auto shares, and it also signals Beijing's commitment to supporting its manufacturing sector, which has ripple effects globally, especially for European car makers.
So how did all this filter through the different asset classes? Let's recap equities first.
Well, as we discussed, mixed signals in the U.S. tech leading, others lagging. In Europe, generally positive, partly thanks to that anticipated demand from China's auto plans. Asia was varied. Japan up on the weak yen, China's CSI 300 like the auto targets, but Hong Kong down on property woes. The big takeaway for you, the listener, it's still this constant rotation between growth and value. Investors are watching central banks like hawks, and earnings season is always critical.
Okay, and fixed income. You said yields eased in the U.S. ahead of the FOMC.
Right. The 10-year at 4.01%, 2-year at 3.52%, 30-year 4.65%. It's investors betting on, or at least hoping for, a less aggressive Fed. Europe was steadier. German bond yields around 2.63%. UK gilts about 4.59%. Seems like inflation expectations might be a bit more anchored there for now.
Makes sense. Foreign exchange, the dollar stayed strong.
Yep. Index at 120.54. That combo of yield advantage and safe haven appeal is hard to beat right now. So the euro dipped below 1.174, the pound around 1.282, and the yen stayed weak, over 151 per dollar, thanks to the Bank of Japan.
Commodities, again, oil capped by inventories despite the attack.
Exactly. Brent, $66.99, WTI, $62.69, shows how quickly supply shocks can be offset by demand data. Gold near records, $3,648.55. And crypto, still looking robust.
Very much so. Bitcoin around $116,140, Ethereum $4,703. Continued institutional interest, buzz around potential ETFs, network upgrades, it all helps. So if we try to connect all this to the bigger picture, what's the overall mood? Volatility seems low.
Yeah, the VIX index, the fear gauge, closed pretty low at 14.71. On the surface, it looks calm despite all these risks, geopolitical stuff, central bank meetings. But If you dig into the options markets, you see rising demand for protection, for hedges, especially ahead of the FOMC and potential news out of Ukraine or related to U.S.-China tensions. So it's like surface calm, but maybe some churning underneath, a cautious optimism, perhaps.
Okay, so what does this all mean for you, the listener, going forward? The week ahead looks pretty packed.
Absolutely crucial week coming up.
Right, mark your calendars. Monday, September 15th, U.S. CPI for August. That inflation number is key for Fed expectations.
Huge. It sets the stage for the FOMC.
Then Tuesday and Wednesday, the 16th and 17th, the FOMC meeting itself, plus their summary of economic projections, that dot plot showing rate forecasts. Everyone will be watching that.
That and Powell's press conference. Market movers, guaranteed.
Wednesday the 17th, we also get the EIA weekly oil inventory report. Thursday the 18th, the natural gas storage report. Keep an eye on those energy numbers. Friday the 19th, that UAW GE aerospace ratification vote result is due. Potential impact on aerospace supply chains there. And then Saturday the 20th, those China-U.S. trade talks in Madrid. Very important for tech and semiconductor stocks, especially after that chip probe announcement.
It's also interconnected, isn't it? That CPI number on Monday, it doesn't exist in a vacuum. It directly shapes what people expect the Fed to do and say on Tuesday and Wednesday. And geopolitical events like Primorsk can shift commodity prices instantly, but then, boom, inventory data comes along and provides that counterpoint. You really have to think about how these catalysts interact, how they could ripple through different assets, creating risks, yes, but also potential opportunities. It's not just a list of dates. It's a dynamic system.
What a landscape indeed. The last 24 hours really show that interplay geopolitics, central bank anticipation, specific sector news, it just underlined how valuable focused intelligence is for navigating all this complexity. And just a reminder, if you're looking for intelligence that helps you stay ahead, not just keep up, check out Next Sight. They support executives, analysts, investigators all over the world with insights that are reliable and, crucially, immediately actionable. You can find them at www.next-sight.com.
So here's a thought to leave you with. We're seeing this resilience, right? Especially in tech equities, despite all these global headwinds, despite central banks sounding cautious. What does that tell us? Is the market showing long-term conviction overriding the short-term jitters? And how might that tension play out? How might it resolve itself in this critical week ahead? Something to ponder.
Definitely something to think about. That wraps up our deep dive into the Saturday, September 13th, 2025 intelligence brief delivered to you on this celebratory 20th edition. Sunday, September 14th. Don't forget to subscribe on YouTube and Spotify. Drop us a like, a share, maybe a comment. We genuinely love hearing your perspective. Here's to the next 20 deep dives. May your Sunday feel a bit steadier than oil prices after a drone strike.